All right.
Okay.
So this is the second problem, the application. We are the investment banking company. We're the investment banker. We were hired by a large tech company to look into acquiring a competitor, another large tech company. So we have to come up with a valuation, and we have to come up with a recommendation. Should they or should they not acquire this company? Okay. The company we're looking at is a large cap tech company in the hardware, software, cloud, mobile, and it's also a global company too that distributes products and services on a global basis. Okay. We're going to use EBITDA as earnings before interest, taxes, depreciation, amortization as the free cash flow. We're going to use 4 intrinsic valuation methodologies. We're going to use the perpetuity, Gordon growth, the multiple approach, and they actually do give us an expected return there. So we should be able to calculate a multiple from that expected return. And we're going to use the discounted cash flow. You have the assumptions underneath. Again, we're going to use the 4 methodologies, and we're going to come up with the DCF and use DCF for present value, net present value. We'll estimate an IRR, break even, and then we'll go through the 4 iterations to decide should we accept or reject the project. So what I would do also, if you were here for the last class, I would pull out your notes to the last problem so that you can refer to them, which will increase the rate in which we can build the model to do the analysis. Okay, and I'm going to go a little bit faster today than I did on Tuesday because you've already been through it once before. Okay, all right. So what's the first intrinsic valuation methodology? Perpetuity. Got it. And what do we need to calculate the intrinsic value using the perpetuity approach?
Cash flow?
We need the cash flow. Last year, this year, or next year's?
This year. Next year.
Next year. Got it. CFO, T+1, what else do we need? What? How do we calculate the, you have to look at the problem, look at your notes, and then come up with the solution as opposed to just writing down the solution and then memorizing and regurgitating it. You're going to put it in short-term memory, not long-term memory. So you have to force yourself to get frustrated and move through the self-efficacy process to learn. That's how you learn, is when you're frustrated and trying to figure things out. You just write the stuff down, memorize it, and then regurgitate it back on the page. You're not going to learn it. It's going to go into short-term memory, and you'll forget it. And then you'll be asked someday, especially marketing majors and entrepreneur and digital media, they're going to come running out of a room someday, and they're going to go, hey, get in here. I need you to come do some calculations for us in the room. We're looking at acquiring one of our competitors, and we need you to run the calculations or help us run the calculations. What's your answer going to be? Yes. Yes. Right? Or it's going to be no, because I wasn't a finance major. I'm a marketing major. I don't do that stuff. Then it's not going to cut it. You want to jump, go grab your calculator and your laptop, and then run into the meeting as fast as possible. Set up. You get pulled in on one of those deals, you're done. You're set. It's awesome. And sometimes luck happens. Okay. So what do we do with the next year's cash flow?
Divide it.
Yeah, we're going to divide it by the discount rate. What are we using as the discount rate for this example?
WACC.
We're going to use the weighted average cost of capital. And I'm going to go over the WACC calculation very quickly because I don't think we're going to get through to that chapter today. Maybe we will. So that's going to give us the valuation using the perpetuity. Under the perpetuity model, what do we assume about the cash flows? Are they going to remain flat forever or grow at a constant rate? Flat. Okay. So how do we get next year's cash flow? What do we do?
Multiply by T plus 1's growth rate.
Exactly. So what do we do? Walk me through.
200 million multiplied by 0.2.
200 million
1.2.
multiplied by 1.2, right? Because isn't that what they give us for the first year growth rate? 20%. So what's 200 million multiplied by 1.2?
40.
140 mil. Got it. What's the next intrinsic valuation methodology?
Growth.
Yeah, and I need more participation. I can't have one person, and like you, a lot, but I need more people participating in the process. Okay? What,
Slightly confused. Do you have to divide that 240 million, or is that the answer?
that's correct. 240 million divided by what?
0.22, I think.
Is it 0.22? Yep. 0.22, and that gives us what? Yeah, I love this sound of calculating.
1090.9.
What is it?
1090.9.
Like that?
No, 1090 point.
Got it, okay. And then just round up. Okay, thank you. What's the second methodology?
That would be the Jordan Grill.
Got it. Got it, okay. And how do we calculate the Gordon growth?
Cashflow next year
Yeah, cash flow next year.
divided by the discount rate minus,
Excellent. Help us out.
Minus the cost of
Minus constant growth. Excellent. Excellent, thank you. So what's next year's cash flow? What is it?
is it the one,
So say it out loud.
the 200,
What is it?
is it the 240 million?
Yes, thank you. 240 million divided by what? 0.22. Got it? Walk me through it. Minus, and what is the going in growth rate? Excellent. 5, and that's gonna give us what? What does that give us?
Final answer is 1411.
No, give me this.
0.17.
0.17, and 240 million divided by 0.17 gives us what?
1412. That's right.
1412 million, got it.
Yeah, that's rather enough.
Okay. And what's the next approach?
Actually, we could probably round up the previous one to
Okay.
1091 actually. Instead of
Which
one.
one?
The perpetuity, we should round up to 1091.
For perpetuity.
1091?
Yeah, we said to round up, so we better, that could be
Got
right,
it.
yeah.
Thank you. Well, let's just round it up. 1.1 billion. And this one? 1.4 million? Does that sound about right for these tech companies? Just right off the bat, does the valuation sound right?
Yeah.
Yeah. And you business majors, you're not like, the psych majors and stuff. You're gonna be dealing, not with people, you're gonna be dealing with business at the business level, and you're gonna be dealing with thousands and millions, and maybe potentially billions of dollars. You'll be impacted, you'll be involved in these types of transactions, okay? And if you do a good job, that'll be great. If you make mistakes, it could be a problem, okay? All right, so what's the next method? What? Multiple approach. Got it. Okay, and how do we calculate the value using the multiple approach?
Cashflow next year
Yeah, cash flow next year
times,
times, year. Gonna give you the valuation using the multiple approach, excellent. Now what's the cash flow next year? What is it? 240 million. Got it. And do they provide us with a multiple? 12%. And how do I just multiply it by 0.12? Is that how you do it? So the value is gonna be less than the cash flow?
1.12.
Okay, so I can do it. Is that how you do it? So basically you just grow it out? Is that a multiple? No, that's a growth factor. So how do we convert this 12% into a multiple? What? Didn't we go over, what is it?
1 over.
Yeah. 1 over. Got it. So what's 1 divided by 0.12? Come on, calculators, click, 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 click.
8.33.
What is it?
8.333 units.
8.3, is that right?
Yes.
Okay, great, thank you. What's 240 million times 8.3?
2,000.
2
2,000?
billion even.
Oh, yeah.
2 billion even.
Thank you. Got it. Excellent, what's the next methodology? DCF, yeah, exactly. What's the first thing I'm gonna need to know?
Present value.
Yeah, exactly. I'm gonna need to know the holding period. What's the holding period?
5 years.
5 years? 1, 2, 3, 4, 5. Do I need any more? Or is that it?
Turn one on.
Yeah, I need one more. Got it. Okay, so I'm gonna need one more. All right, then I like to set these up. Year 1, 2, 3, 4, 5. So what do you want to do first? Do you want to do the cash flows or the discount factors? I usually like to do the discount factors. Discount factors. Okay. And this way, when I write these numbers up, I can match them. It allows me to just audit, check my work. I'm gonna need to calculate the discount factors. Do this. And we know that this is gonna be what, 1 point what?
2,200.
1.22, 1.22, 1.22, 1.22, 1.22, got it. Okay, what's 1.22 to the 1? 1.22. And what's 1.22 squared? This is where I like to hear the calculators.
1.4884.
Just round up.
1.449 then.
49.
1.49.
Okay. 1.22 cubed. Again, I like to hear the calculator clicks.
1.82.
1.82. And 1.22 to the 4th power. 2.22, is that correct?
Yes.
Yep, thank you. And what's 1.22 to the 5th power?
2.70.
Thank you. 2.70, awesome. All right, we're cranking. All right, so what's the cash flow we're gonna use in the first year? What's the cash flow we use in the first year?
40 million.
Was it? 240, got it. second year?
Multiply by T equals 200.
How do I get the second year? Second year? How do I get it? Second year?
From cash flow,
You got it.
cash flow growth rates,
Got it.
yeah.
Yep. So which one do we use?
T equals 2.
Yes, and which is?
18%.
Okay, and then what is it? What's it? Come on, say it. Nope. What do I multiply by? What? 1.18, exactly. Walk me through it, okay, walk me through it. Walk me through the detail.
I have a question.
Yes, sir.
Are you multiplying 240 times 1.18 or
Yeah.
200?
No, 240, because we already calculated. This was this year's cash flow.
Okay.
So we grew it out to get next year. So then we use next year's as the first year.
Okay.
Okay, excellent. Thank you for clarifying. What's 240 million times 1.18? 280, just around. Thank you. And then how do I get the third year?
Multiply that by 1.15.
Got it, 1.15, which is
325.
325. I heard one person. Yep. Compensation.
326.
Yeah, rounding up would be 326.
Got it. Thank you. I love it. I love it. And then how do I get year 4?
Multiply by 1.12.
1.12,
Which is 365.
which is 365 mil. Got it. Okay, how do I get year 5? 1.06, thank you.
Which is 387.
Which is 387 million. Got it. Is that it? Do we need one more? Why do we need one more? We need to calculate the terminal value. Excellent. And what do we multiply the 5th year cash flow to get the 6-year cash flow to calculate the terminal value? What is it?
1.03.
1.03. And what is 387 million multiplied by 1.03?
398.
398. Excellent. Okay. Now, you as the analyst have to make a decision. Are we going to assume that the cash flows are going to remain flat forever, or are going to grow at a constant rate? So what kind of company is this? Yeah, is it large cap, small cap? Large cap, large cap. So what's the probability that the cash flows are going to grow at a constant rate for a long period of time? This is a large cap. Yeah, constant. It's not going to remain flat. Okay. So what model do we use? We use Gordon Growth. Okay. And does it give us, do we use the going in discount rate, or do we use the terminal discount rate? Yeah, well, to get the terminal value, are we gonna use the going in discount rate or the terminal discount? Terminal, and what's the terminal?
1.22 to the power of 6.
What?
1.22 to the power of 6.
No. Yeah, we're calculating the terminal value, we're not, we haven't, you don't discount back the 6-year cash flow and then add it all up, you gotta get the terminal value. What we're trying to do is we're growing out the cash flow to the end of year 5, and then we're calculating the terminal value, because we can't, I can't go out 30 years to calculate the discounted cash flow. This actually accelerates the process to come up with the terminal value. I'm sorry, did you say?
I minus G, the discount rate, minus.
Yeah, what's the discount rate? No, the discount rate, the terminal discount. What are we using?
24%.
24%. Okay, and then do we have a growth rate? Do we use the going in or the terminal? Terminal. What's the terminal growth rate? 0.03. That's gonna give us 0.21. Okay, theoretical question. Why am I using a higher discount rate than the going in? Why wouldn't I just use the going in? In the book, it shows that you're always using the going in for the terminal calculation. Why would I use a higher discount? Theoretical question. Why would I use a higher discount rate? Is there a positive correlation between risk and return? In return, is risk and return, are they positively correlated? So the higher the risk, don't you want a higher return to compensate? Okay. Do you think that these tech firms from year 6 for the next 30, 40 years, can you forecast with perfect insight of what the firm is going to be subjected to from year 6 on? No. Okay. Is that risky? The unknown is risky, isn't it? Yeah, and don't you want to be compensated for risk? So that would be one reason. What about this firm? Is it a tech company? Is it a tech company? Yeah, are tech companies subjected to intense competition? Is that risky? Absolutely. Look at the tech sector. It lost $1 trillion this week. $1 trillion in market cap was lost this week by the top 10 companies. $1 trillion. What about technology? Does it change rapidly? Yeah. So basically your technology that you're implementing or your product can become obsolete very quickly, couldn't it? Yeah. So you want to be compensated for the risk. So you increase the terminal discount rate. What about the terminal growth rate? Why didn't we use the 5%? Why did we take down the growth rate? Exactly the same problems, right? Additional risk, intense competition, very quick obsolescence within the technology that you utilize. So you got to take down the growth rates to reflect that risk. Okay, so what's that 398 divided by 0.21?
1,895.
1,895?
96.
6? Got it. Thank you. And what does that give us? What does that give us? What were we calculating? The terminal value. Got it. And then what do we do with the terminal value? What do we do with that?
Add it to 5.
Yeah, we add it to the last year in the holding period's cash flow. Got it. Thank you. And what is 1896 plus 387? 1896 plus 387. What does that give you?
2283.
What is it?
2283.
2283 mil. Got it. So that's the total cash flow you're going to receive in the last year of the holding period. Got it. Now what do we do with that?
Divided by the rate.
Which one?
Discount rate. 1.62.
Yep. Or the
2.7.
2.75. Boom. Got it. So what's 2283 divided by 2.7? 2283 divided by 2.7. What does that give us? Calculators. Calculators.
Yeah, 845, but.
Are you doing the calculators on your phone? What is it?
846.91.
846? Got it. Now what do we do? Now what? Walk me through. You're going to be making presentations, you're going to be doing stuff like this in front of senior managers, investment committees, boards of directors, clients. Then you're going to jump on the board and you're going to start diagramming stuff, walking us through stuff. So what do we do now? What's the next procedure? What's the next step? Say it?
You add them.
Nope. What do I do now?
Calculate for year 43 and 71.
Yep, so we go back. So what is 365 divided by 2.2?
164.
Mil, can somebody confirm that? Okay, anybody else want to confirm?
Divided by 2.2.
2.22. Yeah. Is that right? Thank you. And then we take this one. It's 326 divided by 1.28. What is it?
175.
175?
Nine.
9, got it. Usually when you're in these meetings with, you know, the hoity-toity, you know, Stanford and Cal students, you know, they're cranking it out and trying to beat you to the calculation. You guys are faster than that. You guys can beat those Cal and those Stanford people, come on. Okay, what's that 283 divided by 1.49?
190.
What is it?
190.
90?
190.
190, got it. Okay, and what's 240 divided by 1.22? 197? Got it. In 19, I think it was 19, what was it? It was like, I think it was 2000. In 2000, I was in a competition with Berkeley with my students from San Francisco State. Cal had basically a law student from Bolt. They had an engineer from the Urban Design School. They had a bunch of students from Haas. They had like a team of 5 students. I had two women. One was a sophomore, one was a senior. 2 against 7. We tied with Berkeley. We tied in the competition. Berkeley was furious. They basically threw down the award and walked out. So I went and picked up the award. Gave it to my students. Yeah, it was amazing. 2 against all of them, and we beat them. You know, we got first place with them. They were furious. They walked out. So we can win. So what's 846 plus 164 plus 179 plus 190 plus 197? What does that give us?
1576.
1576. Can you confirm that?
Yeah.
Okay, good. All right, awesome. So we got perpetuity, 1.1 billion. We got Gordon growth, 1.4. We got multiple approach. We got 2 billion, and for the DCF we got 1.6 billion. Okay, got it. Now we need to be able to reconcile those 4 methodologies and come up with a point estimate. How do we do it? How do we do it?
Which ones apply to the scenario?
Exactly. Exactly. Depends on the scenario. So what do you think about the perpetuity approach? It's too simplistic. Gordon growth is pretty simplistic too, but at least it takes into consideration the constant growth rate in cash flows. The multiple, that's a pretty good one too, and the DCF is pretty good too. So just based on the 3 methodologies, how would you reconcile them and come up with a point estimate? It would be an approach that would be fairly valid.
Average number.
You could, or could you just take the median? You could take the average, or you could take the midpoint, which would be the DCF. Right? And these types of scenario, this scenario, lends itself more because it's an established large cap company, lends itself towards weighing more or going more towards the discounted cash flow. Because these types of transactions don't occur a lot, so the multiple approach is not very reliable. And the Gordon growth model is pretty simplistic. So the model that basically is more aligned with the scenario that we're doing, the case that we're doing, is really DCF. Okay? So we're going to use the DCF. In the last class, what they did was they, I think they threw out the multiple and then took an average between the Gordon growth of this, which was okay, but I'd rather use this. This is the one.
Why did you take out the multiple?
Because they didn't think it was applicable. Because there wasn't a lot of transactions that had occurred, you know, that warranted using the multiple approach. Personally, I don't think they should have done it that way, but they wanted to do it that way, so I have to be open. But I think the DCF model is the right model to focus on. But are they all relatively close to each other? Are they all relatively close to each other in valuations? Yeah, compared to the one we did the other day, where the multiple was huge compared to the other ones. These all kind of cluster together, so that's a validation. in its own, right, okay. All right, so let's go over here and play around a little bit. Let's start the capital budgeting process now that we've done the intrinsic valuation work. I think I poured it, just order when it comes to highlighters. So what do you need to calculate next? What do we need to figure out? What do we need to calculate? It's on the page. We gotta
Oh, the
calculate.
MPV?
Yeah, we gotta calculate the net present value, because we've gotta figure out if we're gonna accept or reject the project, the acquisition. And we're the investment bank, and we're advising the acquirer. We're advising the acquirer when we've identified a target, okay, a target firm that we wanna merge with, that we wanna acquire. Okay, so what's the intrinsic value? 1.6 billion. Right. And do we know what the acquisition price is? Or what the offering price is? How much? How much is it? 4 billion? Wow. That's a lot of money. So what's our net present value? What's our MPV? Yeah. So what's our MPV?
Negative 2.4.
2.4 billion. Got it. This is our first iteration. Based on the first iteration, the first pass, as we say, based on the first pass, would we accept or reject the project? Would we accept or reject? We would reject it. So we gotta go back to the company and say, based on our calculations, you know, we get a negative net present value and you should not buy the firm. Okay? Now, having such a large net present value probably means that either we messed up in the calculations, or there's something else that's not being factored into the valuation. Because where did they come up with the 4 billion? They must have used some kind of model to come up with that. So we're probably missing something. When the MPV is small, we probably have a lot of the factors in the data, okay? But when it's so wide like this, there's something going on. Okay? Either we messed up, or there's other factors that are being included in this valuation that we don't know about. And is the selling firm gonna tell you everything? No, heck no, they're not. So what do we do next? Because I don't feel comfortable going back to my client and saying we reject the project because we have such a large negative net present value. So what would be our second iteration that we could do?
Price reduction.
Yeah, go through your notes. What?
Price reduction.
Yeah, you ask for a price reduction. You go back to the seller and you ask for a price reduction in what amount?
2.4 billion.
Yeah, you ask for a price reduction in the amount of the negative NPV, which is negative 2.4 billion. Got it. Now, do you think that the seller is going to give you a $2.4 billion price reduction? Do sellers ever give you price reductions? If they're playing hardball, probably not. Sometimes they will, because they probably, do sellers sometimes overinflate their sales prices? Oh yeah, because they want room, they want to have room for negotiation. But I hate to tell you, that we went back to the seller, asked for a price reduction in the amount of the negative MPV, and they said no. Or actually, to be honest, we didn't even go back. We just basically said, you know, the MPV is just too much. And so we're gonna skip that, but this is the next iteration. What would be the next thing if we really want to do this, to acquire this company that, you know, the acquirer or, you know, our client said, we really want this company? Exactly. So we would reevaluate the assumptions. Give me the assumptions. What do we go back and we're gonna go back and re-underwrite? Does data come in
Yes.
all the time that could change the evaluations? Yeah, exactly. So we gotta go back and reevaluate our assumptions and recalculate the intrinsic values. So what assumptions would we go back and audit and reevaluate?
EBITDA,
Huh?
EBITDA,
Which one?
Q0.
Yeah. So we go back and look at the initial cash flow. Okay, what else? What other? Come on, interactivity, thinking, go back, audit the assumptions, look at the assumptions that we're looking at. What? Yeah, the discount rate. And how many discount rates do we have?
Two.
Two. Which ones? Going in. And with the other one? Terminal. Got it. And what are we using as the discount rate? What are we using? Yeah, what are we using? We're using WAC. So we're using the weighted average cost of capital. Got it. And what's the weighted average cost of capital calculation? No, not, what is the number, and how do you calculate it? If you don't know, go online, go to PowerPoint, go to blah, blah, blah. We haven't gotten to this chapter yet. I forgot. Who's presenting the cost of capital chapter? Okay. So you guys should know this. How do you calculate the WACC? Cost of the equity times the weight of the equity plus the cost of the debt, 1 minus the tax rate times the weight of the debt. Is that right? Is that correct?
Yep.
Yep. And how do we calculate the cost of the equity? What equation do we use? Remember I had at the midpoint of the semester, I had you tattoo two equations, one on your right ankle and one on your left ankle. The one on the right ankle was the Fisher equation. The one on the left ankle was the, well, that's, the WACC you're gonna tattoo on your, someplace else. Okay? What's the, how do we calculate the cost of the equity? What equation do we use? Test question. It's the same equation that you would use to calculate the expected return on the equity. Come on, you gotta memorize this. Look under your left ankle. It's right there. Can I use the capital asset pricing model? Yes or no? Yes. And what's the capital asset pricing model? Quick search, go online, Google, what's capital asset pricing model, boom, comes right up on your phone. CAPM, boom, comes up in like 2 seconds.
Risk-free rate plus market.
Yeah, it's the risk-free rate plus the
Beta
beta, got it,
multiplied by the expected market.
return on the market, got it,
Subtracted the risk-free rate.
got it. Excellent. And then how can we calculate the cost of the debt? Can I use yield to maturity on the debt? Can I use that? Can I calculate the yield to maturity on the debt? Yep. Can I use the risk-free rate plus some series of risk premiums? Tack on credit default and maturity and those things, can I do that? Can I do that? Yep, I can do that too, got it. And then the tax rate, can I calculate the corporate tax rate? Yep, I can calculate that. And then how do I calculate the weight of the equity and the weight of the debt? How do I calculate the weight of the debt and the weight of the equity? How do I do that? Can I use the market value of the equity? Can I use the market value of the equity? Shares outstanding times the stock price? Can I do that? And if I take the market value of the equity, and I divide it by the market value of the equity plus the market value of the debt, if I take that, can I get the weight of the equity? If we take the market value of the equity, divided by the market value of the equity plus the market value of the debt, can I get the weight of the equity? Yep. What if I do minus 1? Weight of the equity minus 1. Can I get the weight of the debt? Can I do that? Yep, I can do that too. Okay. All right. Excellent. What else? What other factors? Yes, sir.
All that is just for the WAC?
Yep. Okay, just wait, because they're gonna present it, and then we're gonna do it, we're gonna apply it at the end of the semester to Gordon's Act. We're actually gonna do it. Okay. What else? What other factors in the valuation model that we need to go back and audit and reevaluate to recalculate the intrinsic values because we messed up? Pro forma cash flows, excellent. Pro forma cash flows, the growth rates. Got it. What else? You got initial, you got pro forma, you got discount rates. What else are we missing? Discount rates, cash flow. Look at the model. Initial cash flow. We're missing some growth rates, aren't we? What other growth rates are we using? What other growth rates do we use?
Free cash flow?
Huh?
Free cash flow growth rate?
Yeah, and from what model?
Would be,
Growth rates. Which ones? Which growth rates? We got the pro forma growth rates.
they're going in and terminal at 5% dividend?
Going in and terminal. Got it. Okay, anything else? Are we missing anything, or is that it? I think that might be it. Okay, now we get to play a game. We get to play Larry's Finance Sing-Along. Have you ever been to the Castro Theater for the Sound of Music? No, you haven't done that? It's really fun. Sing, get dressed up, go to the Castro, and you sing to the sound of music. Everybody's singing. Well, this is Larry's Finance, Sound of Music Sing-Along. So let's go through this, and I need to hear you, participate and yell out the answers, okay? All right, so the initial cash flow, okay, if we're getting a negative net present value, did we under or overestimate the initial cash flow? Is it too high or too low? Is it too high or too low? Too low. So did we over or underestimate it? We underestimated it. So if we underestimated the initial cash flow, very first cash flow, okay, and we revise it upwards, what happens to the present value? Goes up. What happens to the net present value? Goes up. What happens to the internal rate of return? Goes up. And what happens to the break even? Goes down. Got it. Okay. And what about the pro forma growth rates? Did we over or underestimate the pro forma growth rates? Over or underestimate? Underestimated. Was it too high or too low? Too low. If we revise these growth rates upwards, what happens to the present value? Goes up. What happens to the net present value? Goes up. What happens to the internal rate of return? Goes up. What happens to the break even? Got it. Okay, excellent. All right. Now we got the discount rates, the going in discount rates, and the terminal discount rates. Did we overestimate the discount rates? Did we over or underestimate the discount rates? Over or under? Over or under? Over or under. If the discount rates go up, what happens to the present value? It goes down. Okay. So did we over or underestimate it? We overestimated. Was it too high or too low? Too high. Okay. So if we can revise the discount rate down, what happens to the present value? Come on, everybody, sing along. It goes up. What happens to the net present value? It goes up. And the internal rate of return goes up. And the break even? Got it. Next. All right. So here's the calculation. Here's another one. Could we have, if we overestimated the discount rate, could we have overestimated the projections, the forward risk-free rate? Yep. Could we have overestimated the beta? Yep. Could we overestimated the market risk premium? Yep. Could we have overestimated the yield to maturity on the debt? Yep. Could we have overestimated the risk premiums on the debt? Could we have overestimated the tax rate? Could we have overweighted the equity? Because the equity is more expensive than the debt. So if you overweight the equity, then the WACC goes up. So could we have overweighted the equity? Yeah, we could have overweighted the equity. Okay, excellent. These are good. Did we over or underestimate? Did we over or underestimate the terminal growth rates? Over or underestimate? Over or underestimate the growth rates? Over or under? Under. Underestimate. If we revise these growth rates up, what happens to the present value? Goes up. What happens to the net present value? Goes up. What happens to the internal rate of return? What happens to the break even? Can you guys get this? Excellent. So, I hate to say it, we had to go back. We spent 2 weeks, another 2 weeks. We've basically been spending a month now underwriting this transaction. Is it expensive? Yeah, this underwriting is expensive. You know, us as the investment banker are charging fees for this. Are investment bankers cheap? No, they're super expensive. Okay, we're doing this as a consulting assignment, an M&A, a mergers and acquisition assignment. Okay, and we're charging them a lot because we have a lot of St. Mary's students that need to pay back their student loans, so we pay them really well. So they can pay their loans back really quickly, and they're really good students too. So we hire a lot of them. Can we run another iteration? Can we go do another step? Because we might be missing something in the traditional underwriting process, in the traditional capital budgeting process. We could be missing something. So what is the next iteration that we could go through to?
Calculate.
We're going to calculate what? what are we calculating? The what? The real call option. Okay. So our fourth iteration, number 4, is we are going to calculate the value of the real call option. Got it. What are the two, when you were asked to do this, what would be the two methodologies that you would use, the two mathematical models that you would use to calculate the value of a real call option? What would you use?
The Black-Scholes.
Yeah, you use the Black-Scholes model. Got it. And what's the other one? Binomial tree. Got it. Okay. You guys know how to do that? No. You'll learn how to do that either in investments or you'll learn how to do it in your MBA program. Okay. Or maybe they'll teach you how to do that. If you ever work with a CFO of any firm, they use these models all the time. Okay. So give me the top 3 factors that drive values for the real call options. What are the main 3 factors that drive values for these real call options?
Time.
Value. Are these, remember, these real call options are not, they don't trade. Okay, this is just a theoretical construct that has been designed to augment the capital budgeting decision-making process. Okay, so time value. The longer the time, the more time value there is, the larger the value of the real call option. What's another factor?
Management.
Yeah. Management decision. Now, management can say, we need to do this right now, or we need to wait, right? Isn't that usually how management works? Based on what we've done, what we've researched, and based on all the knowledge we know, we need to do it now, or we should wait 6 months, right? Can management do that? To basically determine and pinpoint the perfect time to execute on something? Yeah, exactly. So management decision making, the decision to be able to execute now or wait, also adds value to the real call option. And then what's the other?
Evaluation.
What is it? What's the third one?
Evaluation.
Yeah, volatility. Valuation. Valuation or the price volatility? Because we could have a scenario, we basically use the call option diagram. This is our exercise price, or our acquisition price. We're going to buy it at. This is the value, price, firm. We're going to have to pay a premium. We're going to have to pay a premium. By the call option. And actually, in this case, in this diagram, the premium is actually the negative net present value. And as the value goes up, you're going to reach some kind of break even. And as the value of the firm goes up, you're going to be in the money. In the money call. The difference between the value and the exercise price is your, not you. Maybe. Now, are tech companies' valuations volatile? Yeah, they're inherently volatile. You can go up and down, and who knows what, and then all of a sudden, valuations spike. Okay, So the probability, the volatility itself adds to the value of the real call option. So I calculated, you calculated, value of the real call option. Got it. Minus the net present value. Net present value. So what does the value of the real call option need to be to get us to make a recommendation to acquire this firm? What does the value of the real call option need to be at minimum?
Negative
What's the minimum?
2.4.
Say it again.
Negative 2.4
Yeah.
billion.
Negative 2.4. Got it. So if the value of the real call option is equal to the negative net present value, then our net present value is equal to what? Is equal to what? If the value of the real call option is equal to the negative net present value, then my net present value is equal to
Zero.
zero. Do I accept or reject? And if the value of the real call option is greater than the negative net present value, then my net present value is equal to what? Is what? The value of the real call option is greater than the negative net present value, the net present value is what? Positive or negative? Positive. If it's positive, do you accept or reject? And if the value of the real call option is less than the negative net present value, then what's your net present value?
Negative.
Negative. And you accept or reject? That's it. That's all you got. Are you guys ready? Who's going first? You guys are ready. You guys want to take a picture of this before I erase this? Oh, am I in your way? Sorry about that. So we basically have time for 2 presentations, 10 minutes each. Are you guys doing cost of capital?
No, self-evaluation.
Yep. Who's going next? You guys are ready to go, aren't you? Yep. So once you guys load up and get ready to go. Did we do chapter 8 and 9 in this class?
We did chapter 8.
We did chapter 8, and you guys are chapter 9. Got it. Okay. Got it. And then team 9. There's no team 9. Team 10. Cash flow budgeting. Okay.
Fundamentals.
Did you guys even look at it, or are you just going to read from the slides?
Let's be honest here.
Yeah, I don't,
Yeah.
just be honest with me and then come back prepared. But you got to come back prepared on Tuesday because we don't have the class on Thursday.
Oh,
Is that correct? That's correct.
Thursday and
So
Friday.
you got 10 minutes. Okay, and then we also have on chapter 14, team 4. Team 4.
That's right.
Yep, okay, 10 minutes. on working capital on Tuesday.
Okay.
Okay, team 5, how to raise capital, a little time. Yep, maybe 10 minutes. You know, not too much time, we don't need a lot of time for those chapters, okay? Okay. Okay. And then when we come back on Tuesday, the 24th, we'll do another problem, maybe more, try to get through them all. And then Thursday, the 25th, I'd like to take a look at the homeworks. And then Tuesday, Thursday, October 30th and November 1st, you'll come back and do just the problems. Okay? All right? All right, did everybody get a copy of this schedule? Okay, you gotta do it over here. Projector. Sorry. Yeah. Please come see me with your stock, oil, and gold memos, staple them together, bring them to me so I can take a look at them, okay? Because I need to walk you through the editorial process. Do you guys know how to write business level quality memos? Nope. Yeah, but the class is just a class. I want to show you how to do it right. If you know of anybody else in the class that hasn't picked up their stuff, can you tell them to come see me so they can pick up the stuff? Okay. Anybody need a extra credit problem set? Number 2. Okay. Anybody else? Smaller than the last one. And again, if you work together, it makes things a lot easier. Anybody else? Okay.
Is that part 2?
Yeah, it's the part 2. So if you're not getting A's on everything or getting A's on your thing, the extra credit will put you up there. Unless you guys don't want an A, then you're crazy. I mean, you're nuts. I mean, I had one student one year, he came to me, I said, dude, what are you doing? He said, you got to go back and redo this stuff. This is garbage. And he said, I said, what grade do you want? I mean, what do you want? What do you want on this exam? What do you want? He said, will you give me a C? I said, are you crazy? Go back and do the work, dude. Go learn the stuff. Get an A in the class. You know, put the time in. It's not hard. It's just work. Okay, anybody else? Okay. How are you guys doing? So you got like 15 minutes. Well, because nobody else is going to go. Speak really loud, yell at these people.
My name is Chiquino. This is Miguel Mason. We're going to teach you how to evaluate stocks and find their intrinsic value. So first things first, what are the stocks or equity securities? Represent certificates and ownership inside a business. Such as if I want to get involved in Coca-Cola, I just go purchase a Coca-Cola stock on the NASDAQ, and now I'd be owning 1 share of Coca-Cola.
So we'll talk about secondary markets. These are where investors buy and sell previously issued securities among themselves in these secondary markets. They provide marketability and fair prices for each share, and yeah.
Second markets and their market efficiency. Second markets differ in the amount of information about prices available to investors which influences each market's efficiency. And there are 4 types of secondary markets: direct, search, broker, dealer, and auction. You know a bit more about that?
Broker would be like Fidelity or Charles Schwab. It's a place where you go to buy shares. You can purchase them through a broker who has a license to basically go to the floor and get these. And the other ones are less efficient, probably won't use them.
And I think the main difference between broker and a dealer is that I think the broker takes on risk, whereas the dealer does not.
A broker doesn't take on risk.
Broker
They're
doesn't
just a
take-
middleman. The dealer actually holds an inventory.
Dealer takes risk.
Yeah, because they hold the inventory.
Okay.
And these are some stock market indexes. These are various makeups of what stocks you want to track. So the Dow Jones basically tracks 30 industrial producers, some of the largest companies in the United States. The NASDAQ primarily tracks big tech companies, and the Standard & Poor's Index tracks the 500 largest companies in the United States. The New York Stock Exchange is a place where transactions occur, and so is the NASDAQ, but that doesn't have a central location. That's just online.
So common stock and preferred stock represents how much ownership you have in a company. So there are others, but these are the most frequent. 2. So preferred stockholders. The difference is the preferred stockholders are promised to preferred stock, but common stocks are, and so they're not guaranteed like common stock are. Right, so that's like the main difference in the biggest difference
Common stock is the basic ownership claim on a corporation. Common stockholders have the right to vote, such as electing the board of directors, capital budgeting, proposed mergers and acquisitions. Also, common stockholders have the right to a firm's residual assets after creditors, preferred stockholders, and others with higher priority claims have been satisfied.
Next up is preferred stock. Preferred stockholders do not have the right to vote. However, they have priority over common stockholders with respect to dividends and liquidation of assets. So if the company was to go under, you would be the first ones to get paid out as opposed to common stockholders. And preferred stock is an equity, but a strong case can be made that is a special type of debt, debt to the corporation that they have to pay you back. And dividends are due regardless of earnings. So this is again the difference between preferred stock and common. And it frequently has a credit rating on it, so you can tell it's credit.
Valuation of equity securities. The value of common and preferred stock is estimated using the methodology employed for bond valuation. Common stock is more difficult to value common stock is more difficult to evaluate than preferred stock.
Then we have the dividend valuation model. The perpetuity model for market value can be viewed as an infinite series of one-period stock pricing models. Here we have the return, the risk return rate plus 1, or the first of the present value, then the first year, then the second year. So then we have the dividend on top of each year as well. Although theoretically sound, it's not practical to add an infinite number of terms. Equation 9.1 is generally modeled for valuing the share of stock.
The equity valuation or stock valuation, we have 4 of them in class, and what one you use depends on whether or not you're going to expect the dividend to grow or the growth rate to stay constant and vice versa. And DCF is the combination of the first 2, perpetuity and GG.
So this is the zero growth dividend model. Pretty basic, just looking at it, right? Dividends over rate of return, and that's for perpetuity. Talk about that today.
The constant growth dividend model. This model assumes cash dividends increase at the rate of growth from one period to the next forever, which is a reasonable assumption for mature companies with history of stable growth. And the equation 9.3 is the dividend at any time in the future is how it's defined. And equation 9.4, the current price of a share of stock is the next period's dividend divided by the difference between the discount rate and the dividend growth rate?
So some firms they invest in will experience high growth in the beginning, and this is where we use the supernormal dividend growth model. Such as a tech firm, if it's in its early stages, it can skyrocket fairly easily, and it's highly volatile. So this is where you combine the two equations to get the supernormal dividend growth model.
Here's a graph showing different kind of like growth rates and stuff. So like supernormal is the blue, and then like so it's like more modest. Like, show the differences.
This one of the questions?
Yeah, now we're on to the homework problem
Yeah.
examples.
Here we got an example of a supernormal growth dividend model. And the question is, suppose a company's expected dividends are $1, $2, and $3 for the next 3 years and are expected to grow at a constant rate of 6% per year thereafter. What should the current price be if the required rate of return is 15%? Then we do the dividend for the year 4 is equal to the dividend of the year 3 times the growth of that particular year plus 1 to the power of 1. So it's $3 times 1.06 to the 1, which equals 318. Then you do the present value. Is that present value? No,
That's terminal value.
terminal value of which is equal to the dividend of year 4 over rate of return over the growth, which is equal to 318 over 15 minus 0.6, which should give you a value of 35.33. And then this present value is equal to the dividends of each year over the rate of return plus 1 over time to the power of each year, so $1 over 1.15 to the power of 1, and then $2, which is dividend the second year, and so giving you a value of 27.58.
And if the stock price was trading at $20, would you buy it? Would you buy the stock if the stock price was trading at $20?
Yes.
And if the stock was trading at $30, would you buy it?
Yeah.
What would you do?
Sell it.
You'd
short
sell it
or-
or go short, exactly.
Okay, so this problem, we're trying to assess whether manufacturing company has been growing at a rate of 6% for the past 2 years. The CEO expects the company to continue to grow at this rate for the next several years. The company's paid a dividend of $1.20 last year. If your required rate of return is 14%, what is the maximum price you would be willing to pay for this company's stock? So here we use the growth model. We take the initial amount, which is 1.2, and we multiply that by 6% to get the T plus 1, which is 1.27. And then we divide that by the required rate of return, which is 0.14. Right there. And then we subtract the initial growth rate, which is 0.06, and we get $15.88 is the intrinsic value on the stock.
So, like, this is, okay, so the question says, Clarion has been selling electrical supplies for the past 20 years. The company's product line has changed very little in the past 5 years, and the company's management does not expect to add any new items for foreseeable future. Last year, the company paid a dividend of $4.45 to its common stockholders. The company is not expected to increase its dividends for the next several years. If your required rate of return is 13%, what is the current value of this company's stock? And so it's dividend over rate of return, which is 4.45 over 13%, which is comes out to be 34.23.
Problem 9.3c. It's basically asking what does NASDAQ stand for, what is NASDAQ? NASDAQ stands for National Association of Securities Dealers Automated Quotation System. NASDAQ is one of the largest electronic stock markets in the world, listing over 3,000 companies. It is an OTC market and does not have any physical location. As Jacquina mentioned before, companies listed on NASDAQ had market capitalization of $6.2 trillion as of December 2015.
Okay, so another problem. You are interested in buying a stock, a preferred stock from a bank, and it pays a dividend of $1.80 every quarter. If your discount cash flows are 8%, what is the value on the stock? So what we first do is we have to calculate it, we have to transfer to quarters, so we take the dividend and we multiply by 4 to get, or divide that by the required rate of return, and that would give us $90. This is just to convert the dividend back into quarters, so then, and then divide by the rate, and we get a value of $90.
Explain why preferred stock is considered to be a hybrid of equity and debt securities. So the law considers preferred stock as equity. Thus, holders are treated as the firm's owners. Also, like common stockholders, preferred stockholders have to pay taxes on their dividend income. However, preferred stockholders do not have any voting rights. In addition, they receive only a fixed dividend, just like bondholders. If a firm is liquidated, then they receive a stated value or the par value similar to bondholders. Preferred stock is rated by credit ratings agencies, just like bonds. Some preferred issues are convertible to the firm's common stock, just as convertible bonds. Some preferred issues are not perpetual and have a fixed maturity, just like bonds. Thus, preferred stocks is a hybrid security, like equity in some ways and like debt securities in others.
Does this one have a question? I think we missed the question for this one, but this should be.
You can just move on, go to the next one.
Problem 9.14c, preferred stock valuation. Eccentric Energy Company has issued perpetual preferred stock with stated par value of $100, and a dividend of 4.5%. If the required rate of return is 8.25%, what is the stock's current market price? So the dividend is equal to 4.5% times $100, which is equal to $4.5. Then you do the dividend over the rate of return, which is 4.5 over 0.0825, which is equal to a preferred stock valuation of $54.55.
So I don't think this one had the answer either, but yeah.
We all know how to calculate that one.
Yeah.
We all know how to do it.
Might be on the next slide.
Okay.
Yeah.
So Triton is expected to grow at a rate of 22% for the next 5 years and then settle to a constant growth rate of 6%. The company recently paid a dividend of $2.35. The required rate of return is 15%. So we have to find the present value of the dividends during the rapid growth period if dividends grow at the same rate as the company. So that would be this section right here, which is A. Yeah, so it's gonna be a lot. It's what we were doing today. So you take the dividend and you multiply it by the growth rate plus 1, so 1.22, and you do that with all the different dividend units, and so you come out with the totals, and then that's that part A. Right? Oh no, and this whole thing. Oh, and then you like do what we did today, which is what we've been talking about this whole time, which is 1 plus the rate of return to the power of what year it is, and the dividends divided by that number, and then you add them all together, and most probably you get $14.
And then you gotta calculate the terminal value.
And the terminal value, which is added to the last year of.
You grow it out one more year, and you take the rate of return, required rate of return, subtract the growth rate, and that gives you 74.80. You add that back to year 5, which was your last holding year, and then add those all up to get the valuation of, what was it? 37.19. Yeah. It's hard to see. I don't know. Computer sort of doesn't show it really well, but that's 37.19 as your final answer. B is just the terminal value calculation that we're doing today, and A is just growing it out for the 5 years. So that's it. Yeah, I think that's it.
I do like the problems in the